This is the entire monthly update of my stock market portfolio. I'll be going through the performance, the buys and sells, a detailed holding breakdown, and also diving deep into the dividend income earned for the month in an effort to be transparent about my stock market journey, just because there are a lot of scams online. As always, smash the like button and the subscribe button. It really helps the channel out. And with that said, let's get into the breakdown. My self-managed portfolio is up to $149,428,000. That's just getting ridiculous now. In the past month alone, this is up $5,738 or 4%. The past 6 months, it is up $16,602. And in the past year, this is up $25,900 or roughly $26,000. That turns out to around 21.38%. Money makes money though, and as you can see in the past month alone, this is up 4%, which doesn't sound like a lot, but that is now $5,700. And as you can also see, I can get a free iPhone or Mac. What a good deal if I deposit $100,000. Anything for a Mac or an iPhone. With the recent crypto rally, all of my accounts are up all time. The TFSA is up 34%. The FHSA, or the First Home Savings Account, is up 26%. The RRSP is up 17.6%. The non-registered is up 6.26%. And the crypto is also up 21.26% now since crypto rallied after the election result. And you'll notice that my TFSA all time is up 34.46%, which is the most out of all of my accounts, since this is the earliest account that I started investing in. This shows you the power of having money in the market. Time in the market is always going to be timing the market. But my newest account, the non-registered or the margin, the cash account in some countries as they call it, is also up a modest 6%. As you can see, I started investing in this pretty recently at around, let's just say July, and just in 4 months or so, it has returned me 6% or roughly $1,000. Not bad. So what did I buy this month for this portfolio? Well, my biggest buy will always be for the near future and the far future as well, the S&P 500. I like this ETF called VFV. It is a Vanguard product, but you can take any ETF you want. The S&P 500 is an index that tracks 500 of the biggest companies in the United States of America. For the last 40 years now, it has returned 10% on average. Not the last 14 years, the last 40 years, 40 years it has returned 10% on average. And I make sure every month I buy a lot of the S&P 500. As you can see, in November alone, I bought the S&P 500 every week to the tune of $1,000 or thereabouts. My second buy is the NASDAQ 100. Similarly to the S&P 500, 100 of the biggest companies in the United States of America, it just so happens to be that this is extremely tech focused. Since the biggest companies, the companies that add the most value, are tech companies. Apple, Microsoft, Google, Nvidia, Tesla, Netflix, you name it, they've done extremely well in the last year, well, the last 5 years now. If you don't think tech is your jam, you might want to stay away from this. But for me, I think tech is the now and the future. The camera that I'm using, the mic that I'm using, the phone that I have in my pocket, the laptop I'm looking at, is all technology in one way or another. All future-looking industries, for example, data or AI, are also part of the tech industry. And so I choose to invest in the NASDAQ 100 to take part in this technological advancement. And you'll see, similarly with S&P 500, every week I buy the NASDAQ 100, since I do think that adding a bit to the NASDAQ 100 is going to pay dividends in the long run. My next buy was in Google. Once again, tech company, search giant, and in some hot water recently with them potentially having to demonopolize search. How this is going to impact Google stock is yet to be seen, but as you can see in the last week alone, it is down 3.79%, with a lot of people saying that if they end their monopoly, they might see a decline in revenue and potentially a decline in stock price. But this is where I think the opportunity lies. Do I actually think that Google has good products? Yes, not just in search, but also now with the Pixel products, Gmail and the Drive suite, and more importantly for me, Google Cloud. With Google Cloud in particular exponentially increasing revenue in the last few years, I think Google is going to see the benefits of, even if it has to demonopolize search somehow. We saw this with Microsoft actually decades ago, where they had to follow regulations and demonopolize their company. It turned out well for them. I think it's good enough to buy one share of Google, which is exactly what I did in November. Not a lot of money if you think about it when it comes to the overall percentage of my portfolio, but just enough to see the gains if it actually does pay off. If it's looking like in the next 10-20 years, Google is not going to do well, you can always repurpose a small percentage of your portfolio. My next buy was in Datadog. Datadog is a company that does analytics, particularly for a company's technical infrastructure. They have analytics and dashboard monitoring that help you make a sense of what's going wrong in your company and even what's going right. It's done extremely well in the last few years, increasing revenue exponentially pretty much. And the best part about this company is that it's also profitable. A lot of other SaaS companies that operate in a similar space do not achieve profitability, but they've done both. They've increased revenue and they've also become profitable. I use their products and I've seen a lot of people vouch for their products, and I do think in a data-driven world in the future, their products are going to be increasingly more valuable. So I've gone ahead and I bought one share of Datadog. I also added USSL. This is a leverage S&P 500 ETF. The S&P 500 we've already covered before. Leverage adds an extra element to that. This ETF that I like in particular, USSL, is 25% leverage, which means that the returns are going to be magnified by 25%. If, let's say, the S&P 500 goes up by 10%, this ETF is going to go up by 12.5% minus leverage costs, or the cost of interest that the ETF provider has to pay. But the flip side is also true. If this index goes down 10%, the ETF is going to go down 12.5% plus leverage costs. You can see the pros and cons here. For me, a younger investor that does believe in the S&P 500 and wants growth, I think leverage can be a good tool to have in my arsenal. I'm not going to be selling this in the near future. I don't plan to. And I think that 25% leverage in 10, 20, 30 years is going to pay nice dividends. And as you can see, similarly with VFB, I bought USSL pretty much every week in November. By the way, also plugging my other series, Invest Weekly, where I invest weekly, quite literally, and show everything I buy to keep transparency and also to motivate people. I also added HEQL. This is a leverage ETF that is all equity. Leverage we've covered before, quite literally before the previous ETF was leverage. HEQL is an all-equity ETF. That basically means that it has not just US and Canadian holdings, it also has international exposure. A thing that you might notice about my portfolio, it is very North America centric. This is my way of getting slight exposure to the international markets, even though I do want to be primarily US and Canadian focused. It's up 29% over the last year, and as you can see, I keep buying every single week. My next investment was in Pepsi. Pepsi is interesting. It's not done well in the last year. It's been down 3% as you can see, and revenue seems to have stagnated a bit. Profit margins seem to have stagnated maybe. But I think that Pepsi has something that is going to be beneficial for it in the future. A, it has good cash reserves to buy brands that can reignite growth in developing markets, which is point B. It still has expansion potential if it can figure out its supply chain problems and pricing strategy. With strong leadership, I think Pepsi is going to be a juggernaut in the future. Right now, it's relatively cheap. The PE is only 23 or 24, with it also being a dividend king. It has provided dividends consecutively for 52 years now, which is one of the major reasons for investing in Pepsi in the first place. And once again, I bought one share, not a lot, but enough to keep that snowball going and keep that compounding effect going as well. Before we dig deeper, if you enjoyed this video so far, smash the like button and the subscribe button. Every subscriber helps get this video to the right people who are also interested in learning how to save more and invest and be more prudent with their money. My next buy was in Snowflake. As you can see, Snowflake is actually down 0.03%, but the data warehousing solutions that Snowflake provides are increasingly valuable in an increasingly data-driven world. A lot of increasing that I just said there. You get the point though. I think Snowflake's products are going to be extremely valuable in their future, and their growth rate is extremely good, particularly for revenue. If they can figure out the profit equation, I think there's a lot of value to be had in Snowflake. My last investment, focusing on the US market, was in HYLD, or a covered call ETF tracking S&P 500. This is a Hamilton product, but there's a lot of covered call ETFs tracking the S&P 500. Why do I like this ETF in particular? There's a couple of reasons. Number one, I like the dividend yield that it brings at around 11 to 12%, not higher than that and not lower than that. And number two, I like that it writes calls on a percentage of its holdings and not the entire portfolio. That basically means that in the long run, all long-term growth potential is not sacrificed for income now. As you'll notice, this doesn't constitute a large percentage of my portfolio, and I don't spend a lot of money buying this every single month to the tune of $50 or $100 every time I buy from a $1,000 buying potential. Although I will be honest and say that seeing my dividend income go up is an extremely good motivating factor for me to stay consistent. This is my personal journey. This gives me an opportunity to take a step back and rejoice a bit and take some of that fruit of my labor of saving and have it now. Well, I don't have it, I still invested, but at least I see it deposited into my bank account. Switching countries, since I live in the Maple Land, I also need to buy Canadian stocks. Well, I don't need to, but I want to, since I do want to believe in the Canadian economy. My biggest Canadian buy is always VDY. This is the Vanguard product that tracks the TSX 60, or the Canadian version of the S&P 500. This includes companies in the banking sector, insurance sector, telecom, gas, everything that Canada is known for. All of the oligopolies. In the past year, it has been on a tear, being up 25.6%, and I keep on adding since I believe that since the Bank of Canada is going to keep on cutting interest rates, people are going to gravitate towards the stock market as a vehicle for investment. Similarly to the S&P 500 and the Nasdaq 100, I bought this every single week, literally. My second biggest Canadian buy is in HDIV. This is a covered call ETF tracking the TSX 60 with some US financial exposure. Also a Hamilton product. You can say I'm a Hamilton guy, I guess. This has been up 18.24% in the last year and has a juicy dividend yield at around 10%. Investment philosophy is pretty much the same as HYLD. I want to take part in that income now. Not a lot of money invested. Since a lot of my money is still growth focused, I still just want to keep motivated. That is my biggest concern, is losing motivation, since growth investors like myself are not going to see a majority of their gains later in life. If there's a large market drawdown for a year or two, as there was, I kept motivated through these monthly payments. It works. For me, it does. Then, as you can see, every week I put some money in HDIV. Not a lot, $10, $20, sometimes $50 or $100, but nothing compared to my entire portfolio. We've talked about the buys now, but how has this portfolio actually done? Let's start with the biggest holding, the S&P 500 or VFB. As you can see, this is up across all my accounts, and my TFSA in particular, this is up 42%. That's nearly 50% now. My second biggest holding, VDY, is also up big, roughly 18% across all my accounts, with the TFSA in particular it being up 20%, FHSA it being up 21%, and the non-registered and RRSP also seeing green for VDY. My largest individual holding is actually Apple, and it's up 35% all time, with Microsoft, my second largest holding, not being far behind. Well, it is far behind now, at 17.4%. It has seen a large drawdown in the last few months, although I still remain confident in Microsoft products. My two biggest dividend-focused holdings, P&G and Pepsi, have different stories. P&G is actually up for me at around 17%, whereas Pepsi has suffered a loss at around 6%. Although, as I mentioned before, the investment philosophy for these remains the same. Keep buying stable companies with decent profit margins for those increasing dividends. The cover call ETFs, HYLD and HDIV, have done extremely well as well, with HDIV being up 13.63% and HYLD being up 13.14%. This is not taking into account the actual dividends you get from these. So adding the 12% per year dividend onto 7% per year return, this is just a gold mine in terms of covered call ETF investing. The Nasdaq 100 or HXU has also been up 13% over the last year that I've actually been investing in it, and HEQL, or the all equity leverage ETF, is actually up 10% now. And speaking of leverage ETFs, if you go to USSL, you can also see that it's up 8%. So across all my ETFs, leverage, non-leverage, covered calls, they're all in the green. Canadian banks have also done well, particularly BNS and CIBC, with CIBC in particular being up 54%, but my major long-term holding when it comes to the Canadian market and banking is BNS. Around $5,000 invested with a return of 21.26%, not taking into account the actual nice dividend yield here. Other smaller holdings in the American market include American Express, a credit card company that I've talked about plenty of times on the channel before. I love the credit card market, particularly for Amex, with travel returning to normal. I think they're going to see nice dividends, up 26% for me over the last year that I've been investing in it. Fortinet, a cybersecurity company that I've covered, steady revenue growth rate, and profit margin is pristine as well, is up 36%, a long-term hold for me, and I'm hopefully going to add to this in the future as I get money. Datadog that I just literally bought and it's already up 1%. I am an investing genius. If this goes up 1% every day, it's going to be up 365% in a year. And it's not just all America. Canadian companies like Enbridge have been up for me 18% now. Manulife Financial, a stock that I love, is up 52%, and Shopify, a growth play for me, is up 100%. This is the first time I've had a stock double. I never thought I would actually know the feeling, but Shopify, thank you so much for making me aware of the fact that you can feel happy in life. Thank you, Shopify. That's all for Shopify. You also have TELUS and Bell, two telecoms that have not done well. I might actually get rid of the telecom sector and just repurpose this money to VDY. Stay tuned for next month's review. With growth-focused companies like Snowflake not particularly performing well for me, being down 14%. This is a long-term hold though, and I'm going to keep on holding for 10-20 years since I do, like I said, believe in Snowflake's products. And while the title of the video is not wrong, I actually have a work-managed RRSP that I include in the total amount. Employees in the United States and Canada offer what is known as retirement plan matching. Essentially, if you put a certain percentage of your paycheck towards a retirement savings account, they match that and put the same amount of money. My employer does this, and I partake in this because for me, I look at it as an automatic 100% return. Every company does this differently. Some companies do it up to a certain percentage, like 4% or 5%, and others do it up to a certain amount. This account now is up to nearly $28,000, with the exact amount being $27,920. I put in $11,000, my employer matched it with $11,000, and there's a decent growth of $5,564. Moving on to my favorite portion of the video is the dividend portion. This portfolio now pays me $4,453 in annual dividends, with the monthly payment being $371, the daily payment being $12.20, and the yield on cost being 3.63%, with the current portfolio yield at 3.03%, essentially meaning that my portfolio, as we've seen, has gone up in value. This has gone to the point where some months I now get $520, which is a ridiculous amount, an amount that I can spend doing anything I want. For now, I just keep on reinvesting to grow this portfolio even further. My biggest pairs are the covered call ETFs, in fact, which, like I said, is a part of my philosophy when it comes to investing, is this motivation that I get from dividends. With HYLD in particular paying me more than $1,000 now, and HDIV not too far behind at $800. VDY, or the Canadian TSX 60, also pays me around $1,000 roughly. This amount does fluctuate because the amount this ETF pays depends on monthly factors and is not really a fixed amount. The S&P 500 also pays around $400, with Canadian staples like PNS, TELUS, BCE, and Manulife Financial also paying me a decent chunk in dividends. You will notice Pepsi and P&G are also there, my two horses, my two stallions, paying me more than $100 a year now. Tech companies don't pay well, like Google, Apple, even Microsoft doesn't pay well, but the point is that they're going to increase their dividends at a much quicker pace, and who knows, one day they might pay at a 2-3% yield. So that's it. That was the entire portfolio, the buys, the sells, the performance, the dividends, and even crypto. As always, smash the like button and the subscribe button if you enjoyed this video, if you like transparency around the stock market and investing in general, because every subscriber helps get this video to the right people. I'll see you in the next one.